The Securities and Exchange Board of India, or SEBI, plays a crucial role in India's financial system. It acts as the regulatory authority for the securities market. Think of SEBI as a watchdog, ensuring fairness and transparency for all participants. From stockbrokers to investors, SEBI safeguards the interests of everyone involved. Its regulations cover a wide range of activities, including trading, listing, and investor protection. SEBI's primary objective is to foster a healthy and efficient stock market. It achieves this through a combination of regulations, guidelines, and enforcement actions. By setting standards and monitoring compliance, SEBI strives to create a level playing field for all. Its efforts are directed towards promoting investor confidence and market integrity. Derivatives, often perceived as complex financial instruments, are essentially contracts that derive their value from an underlying asset. Imagine you agree to buy a certain quantity of rice from a farmer at a predetermined price in the future. This agreement, in essence, is a derivative contract. The price of this contract is linked to the price of the underlying asset, which in this case is rice. Derivatives can be based on various assets, including stocks, bonds, commodities, and currencies. They serve multiple purposes, including hedging against price fluctuations and speculating on future price movements. For instance, an airline company might use derivatives to lock in the price of fuel, protecting themselves against potential price increases. Similarly, an investor might use derivatives to bet on the future price of a stock. SEBI's new proposal aims to introduce significant changes to the derivatives trading landscape in India. One of the key aspects of the proposal is the introduction of a new trading platform specifically for derivatives. This move is expected to enhance transparency and efficiency in the derivatives market. Additionally, the proposal suggests changes to the margin requirements for derivatives trading. The proposal also seeks to tighten the eligibility criteria for participating in the derivatives market. By imposing stricter norms, SEBI aims to ensure that only informed and financially sound entities engage in derivatives trading. Furthermore, the proposal introduces measures to strengthen the risk management framework for derivatives. Section 4. BSE and NSE. Navigating the shifting landscape. The Bombay Stock Exchange, or BSE, and the National Stock Exchange, or NSE, are the two leading stock exchanges in India. SEBI's new proposal is expected to have a significant impact on the market share of both exchanges. The introduction of a new derivatives trading platform could potentially lead to increased competition between the two exchanges. Currently, NSE dominates the derivatives trading segment with a larger market share compared to BSE. However, SEBI's proposal could alter this equation. The new platform's features and functionalities, along with the regulatory changes, might attract more traders and investors to BSE. This, in turn, could lead to a more balanced distribution of market share between the two exchanges. Section 5. Investor impact. A mixed bag of opportunities and challenges. SEBI's new proposal is likely to have a mixed impact on investors. On the one hand, the increased transparency and efficiency brought about by the new platform could benefit investors. The stricter eligibility criteria and enhanced risk management framework could also enhance investor protection. However, the changes in margin requirements and other trading norms might pose challenges for some investors. For instance, the new margin requirements could increase the cost of trading for some investors, potentially impacting their profitability. Additionally, the tighter eligibility criteria might restrict some investors from participating in the derivatives market. Overall, the impact on individual investors will depend on their trading strategies, risk appetite, and financial capacity. Section 6. The road ahead. Implementation and regulatory timeline. SEBI has outlined a phased implementation plan for its new proposal. The first phase will involve consultations with stakeholders, including stock exchanges, brokers, and investors. Their feedback will be crucial in shaping the final regulations. Following the consultation process, SEBI will issue detailed guidelines and a timeline for implementation. The entire process, from proposal to full implementation, is expected to take several months. During this period, SEBI will work closely with market participants to ensure a smooth transition. The regulator is committed to addressing any concerns and making necessary adjustments to the proposal based on stakeholder feedback.